This chapter is on the statement of cash flows, and we're going to be discussing both direct and indirect in this PowerPoint, but your work will be done in the indirect method. Understandably, this is toward the end of the textbook when you are taking your introductory accounting class, and it might not get as much coverage as it should have because it's one of the 4 statements that are required, and therefore you should be able to read it and interpret it and understand it. Whether you are going to be an accountant or where you're going to be working in finance, you should understand how the cash flow statement is developed, created, and you should understand what it means when you look at a cash flow statement of a company. So the purposes of the cash flow statement is one of the learning objectives, and the other one is using the indirect method with the T account approach. And in your module, as you work through it, you will find that I will give you a cash flow statement and show how it is developed for a company. And this is Carpet Company. And then you will have an assignment to work through a cash flow statement, and I will give you similar information and you'll work through that using the indirect and the T account approach. The purpose of a cash flow statement then is to show the use of cash, what the firm does with the cash that it has, where that cash is coming from, and then the balance of cash. The least important of those 3 is the balance of cash. A firm cannot survive if it does not have cash coming in. So in the long run, if you looked at net income for a company and if you looked at cash flow for a company, they would be the same. There's just temporary differences so that at one point in time net income may be higher than cash flow, and another point in time it may be reversed. People like to say that all accruals reverse or all deferrals reverse. It's only the timing of the cash flow. But if you have a company and the company has profitable net income, but it does not have a positive cash flow, you have to understand that eventually it will reverse and their net income is going to be negative. So when you look at cash flow and you see a company that doesn't have positive cash flow, you have to tell yourself that company is not really a going concern. It can have a temporary deficit in cash, but it can't have a deficit in cash that's prolonged or consistently there. So if you have a firm like that and it's not a going concern, then one of the issues then is how you do the accounting. Because one of the fundamental assumptions we have when we do our accounting using accrual basis, which is GAAP, is that the firm is a going concern. If they're not a going concern, then you have to go back and you have to do all the financials differently. So it doesn't have an impact just on this cash flow. It has an impact on how you do your accounting because, again, if it's not a going concern, consistently not having cash flow, then you cannot put out your financials in the same way. Well, our concern then really is looking at the cash flow statement for one period of time. We're not looking at it over periods of time. We're looking at just one, and it's a snapshot, and it's a snapshot of what happened within that year. But it gives a good snapshot, a good indication of what the company is doing and what the company is doing with their cash. It kind of also tells us what the priorities for the company are. Tells us a lot of things. So the firm can take the cash and they can use it or have it coming in, I guess, from operations, what it does day to day. It can have, and once it has that cash, it can invest the cash. And the other source of cash, by the way, is going to be from financing. They could have a source of cash from investments in that instead of buying investments, they are selling off their plan assets. And generally, we don't like to see cash being generated from selling off your plant assets unless you have a valid reason for doing it. Maybe you are eliminating a branch of your business, or stopping a segment, a typical segment of your company. You are just discontinuing those operations. There's reasons there where you might have investments going down. But what you need to really do is look at the company, and look at the company in the total picture, not look at just operations, not just look at investments, and not just look at financing, but try to put it all together and look at it. As you prepare the cash flow statement, you have to memorize this OIF, O-I-F, OIF, because that is the order in which you'll be preparing your cash flow statement. Doesn't matter if you're using direct method, it doesn't matter if you're using indirect method. You are going to put all the operating activities together, all the investing activities together, and all the financing activities together. And the other thing you have to do is you have to categorize your cash changes into each one of those categories. So operations is generally thought to be a good source of cash. And if you really want to value the quality of the financials, that is whether the financials can be trusted. Say you're an investor and you're looking at the financials and you just don't know if the company is on the up and up or not. One of the ways investors value the financials is to compare net income to cash flow from operations. The amount that's in the middle, you could think of it as a reconciling amount. That in the middle thing is the amount of accrual or deferral adjustments to go from net income to cash flow. The closer your net income is to the cash flow from operations, the better the quality of your earnings. That is, the more reliable it is as a value of the company. And so the stock valuation of two companies, one company where net income and cash flow from operations is about the same number and it's positive, will be valued much more highly than a company where net income is positive but cash flow from operations is negative. So that's my example for you. So you look at it and you want to see that it's getting a lot, you're getting a lot of cash being generated from your operations, because that's what you do day to day. Because if you don't have cash being generated from operations, it means you're having to finance your day-to-day operations. That's a bad thing. So as I said before, you really have to look at the whole thing combined to get a picture of the company. It's really better under I to not be selling off your investments unless you're altering your operations. From retail, we often close unprofitable stores. And that's a good thing. You have to realize that you're not being profitable. This is not working for your company. So you're adjusting and you're changing your operations. So that totally makes sense. But you shouldn't be selling off your investments in order, again, to finance your operations. Now, financing is good source for expanding your operations. But if you're not expanding or you're not updating and you're using just your financing to cover your operations, this is a bad thing, because it generally means that there could be also a gap between net income and cash provided from operations. So you see how you kind of put everything together, and you look at the company overall by evaluating the total cash flow statement, and also thinking about the other information you know about the company. The balance of cash is really the least important thing on here, but we use it, and at the bottom of it you're going to see that it's double underlined, which, as I said before, means darn, I'm good, right? Because it ties back into your balance sheet, and so you're double underlining it and showing that. So this is kind of a sort of a walk forward that's kind of put at the bottom. It says, what's the change in cash? What's the beginning balance in cash? And therefore, what is the ending? And so it's a kind of a walk forward sort of thing done even at the bottom of the cash statement of cash flows. Another way to look at the cash flow statement is to consider what phase of the product life cycle that the company is in. In the beginning, when you have companies that are in their initial public offering stages, or even before that, when it's a corporation but there hasn't been a public offering yet, you see a lot of financing happening. So the cash flow is coming from the financing, and that's because the operations are not strong enough yet to be able to generate cash. And this is fine for that early stage, the introductory stage. And if you're also this blue line then indicates the financing. And then operating, as I said, is going to be low. And the investing, as they're just starting out, they are going to be heavily investing. It's just that the size of the company is going to be small. And that's why you see this as being low. As a company matures, you see that the cash which is generated from operations was negative, but now it becomes positive, and this is what we'd like to see. Growing, growing, growing until the company matures. And then you also are going to see that as they're getting the cash and they're growing, they are investing. So in the growth phase here, they go from having negative cash flow here to having positive. And in other words, they are starting here to actually start really rapidly investing in assets, and that are then it translates to this graph. Now, after it gets to maturity, you see some things declining. They don't have as much a need to invest, and their cash which is generated from operations tends to become reduced, and to the point where the company declines. Not all companies are going to have this perfect shape. The boxes in here, the phases, are done deliberately and even amount. So there's an even space in between these as far as time. That's not the case. You have to determine where your company is, and then you have to look at this and make sure that if it looks to you that they have a problem because they have a lot of financing going on and less cash generating from operations, we said that tends to be a bad sign. It might just be because the company is just starting out. So you also are going to have to look at this, consider what phase this company is in. In our cash flow statement, we said one of the important things is to look at net income and to compare the difference between net income and cash from operations. And we want those to be close together. So what happens? What's the middle part? Well, the middle part, if we are doing this and we are doing it according to the indirect method, one of the differences in there is the increases and decreases from current assets and current liabilities. You exclude cash when you do this from the current assets and current liabilities. So you look at a balance sheet and you're going to look at the changes from one point in time to the next point in time. And you're going to say, do our current assets increase or do they decrease? And the rule of this is that if your current assets increase, you show it as a negative on this cash flow statement in the operating section, and that it shows up as a decrease to the net income. So you list net income first, and if your non-cash current assets increase, it shows up as a decrease in that operating section. And also then, if you show a current assets, non-cash current assets increasing, it shows up as a decrease, and if it decreases, then it shows up as an increase. So my quick way of approaching this is to memorize that current assets reverse the sign. Any increases show up as a decrease in the operating section. Any decreases show up as an increase in the operating section. When you're looking at current liabilities, then when you have an increase in current liabilities, that is an increase in the operating section. And when you have a decrease in current liabilities, it's a decrease in the operating section. So the way I'll say that is current assets, and remember to not exclude cash there, reverse the sign. So when you put it in your indirect method operating section, put it in the opposite way of the change between those two balance sheets. Current liabilities, you're going to put it in there in the same signage. And when we go through our carpet company problem, you will understand how that actually works. Operating activities are the cash effects of most transactions that make up net income. And because you are using the accrual basis for net income, though, the accruals is what we call it, will need to be removed to get to the cash flow. Investing activities include buying and selling of fixed assets. So if you have cash coming in from investing, it means that you have sold off something, and that's probably not always a good thing. And then it says, and making and collecting loans. Well, they're talking about loans as investments. They're not talking about the liabilities of the company. They're talking about loaning things out to others. Financing activities are anything really that has to do with the equity section and that also has to do with long-term liabilities. So it's non-current liabilities, and it's also the equity section. Now let me be a little more specific when I talk about the equity section. You have retained earnings, you have common stock, you have paid-in capital accounts. These accounts are in the equity section, and you have changes which are happening there. In the retained earnings, the things which we would be looking at then would be dividends. And the dividends need to show up here in the financing activities. Net income, where does it show up? Well, if you're doing the indirect method, it's showing up there in the operating activities. So with retained earnings, the things which reduce it are the ones that are going to show up in financing. What if you had a loss for the year? Well, I'm not going to give you a problem with a loss, but if you had a loss for the year, it would show up in operating activities. So the typical things that reduce retained earnings are going to show there in financing activities. The other things which you show there would be treasury stock, and you know about treasury stock, so if you have a treasury stock transaction, it shows up in there. And then, of course, the dividends. So there are a lot of different things that you should think about in terms of financing other than just of issuing stock or taking out long-term liabilities. And by the way, remember leases? Leases are a long-term liability, so the leases are in the financing as well. In your statement of cash flow, when you use this, this is from a particular textbook, and I'm referencing the textbook up there with the KWW, KISO, and then Wigand, and I forgot the last W. Anyway, this is a statement, and this is the indirect in one of their illustrations they had in their textbook. And when you use the indirect method, then in the operating section, you're going to have net income listed first, and what you're going to get to is net cash provided by operations. So as I was saying before, typically you want these to be positive and you want them to be close together. So they're close together and they're positive if you have a strong company. And then the adjustments to reconcile net income, which go in the middle, will include the current asset change, the current liabilities change, and it'll also include anything which could be a item which shows up in income but which is not a cash item. So you have depreciation, amortization, and depletion are the easiest ones I can come up with right now. Well, there's more we'll get to. They show up in here as adjustments. The other thing we'll have is the gains or losses. So gains or losses show up here as well, and we'll get into those details. Then we have the investing listed, and you show what's happening here. Either cash is going to come from investing or used by investing activities. You list out specifically what those are. Then you'll list out all the financing activities. Then you come down, and this total that is right here is the total of your net cash provided by operations or used by operations, your net cash from investing, and your net cash from financing. You come up with this, you come up with your beginning, which is also the previous balance sheet number for cash, and this. Now, the statement of cash flows is based upon the cash count, yes, but if a company is large, it'll have cash equivalents, which are very short term in nature, and it's a classification you had in Intermediate 1. So those cash equivalents are also included with cash to create a cash flow statement. So instead of saying beginning cash at beginning, it would be the cash and cash equivalents combined at beginning. And this would be the cash and cash equivalent balances combined. And of course, then this change is going to be the change in those two accounts combined. So then all of this includes the cash equivalents. The two approaches are the direct and the indirect. The problem you have with the direct method is you'd have to go back and look at all the debits and all the credits. Every debit, every credit needs to be categorized as an O, an I, or an F. And if you can think about that and you've had AIS, you know there are multiple cash accounts, and that you know that if there's a very large entity, a consolidated entity, I do not even want to think about how many cash accounts there are, how many cash transactions there are, and that is just too much work. So what a company does, and what most companies do, is the indirect method, and that's why I'm teaching it to you, not because I'm a cruel, mean teacher, but because the indirect method is the method that most companies will use, and you need to be familiar with it. So this analysis using the indirect is based on the changes in account balances, and it shows how all the account balances are really tied together. And I think it's very good for you at this point, because it is also rather a view of Intermediate 1 and Intermediate 2 when you get to it, because you get into the amortization and understanding how amortization affects the accounts, and that amortization, depreciation, depletion, all these do not affect cash, but how that they affect the income statement. So I really do like the indirect method. It also helps you understand better the theory of accounting. So I hope you will take some time when you go through that cash flow statement and look at it with Carpet Company, and then you apply it to your homework, because it's very helpful in your understanding of accounting. The direct method, then, as I said, you're just going to go through there, and anytime you have a debit, it's called a source of cash. Anytime you have a credit, it's a use of cash, and you have to classify everything. A lot of work. This is from the Garrison Noreen book. Operating activities under the direct method are receipts from customers, the cash dividends. This is on your investments. Okay, so we're talking about the inflows that are coming in, and you would think of these as revenue, cash revenue, and the outflows would be cash expenses. And This obviously is the direct method. If you use the indirect method, you're going to start with the income statement and then show adjustments to the income, adjustments to net income, and come down and get to cash flow operations. Investing, whether you use direct or indirect, you're going to go through and you're going to look at the inflows, you're going to look at the outflows, and the long-term productive assets. We tend to call that PP&E. So anything that's categorized really as a long-term asset, transactions in those, and transactions in investments, other than those that are, say, the cash equivalent type items, are the things that you're really looking at. So you're looking at PP&E and you're looking at investments. And remember when we did our leases that we had right of use assets, and we said that those things were classified as long term. So when you do leases, you notice that you're also creating an asset, and that asset is a long-term asset, not the same as, say, your outright ownership of something, but it is a long-term asset. In financing, then, this is where it gets a little strange, because when you issue your security, that will create cash for you. When you issue bonds or you have notes, and these are not current notes, and then you have other types of liabilities. Again, it says issuing short or long-term liabilities. I would say if it's a current liability, you're going to not show it. So I kind of disagree with Garrison Noreen. In your homework and in the carpet company problem, one of the first things you need to do is figure out if the liabilities are long-term or short-term, or long-term or short-term, and it's going to be obvious to you which are long-term and which are short-term. The other thing which happens that causes you to have a reduction in cash is when you pay dividends, and when you purchase your treasury stock, and when you pay off the loans, and the loans are going to be the long-term loans. And then if it says paying owners withdrawals, well, for us, we're just going to have corporations, and so we're going to be talking about dividends. Now, if the dividend is not done in cash, that's another thing we need to be sure and talk about when we're talking about these activities in investing and financing, is it has to be a cash activity. If it doesn't involve cash or cash equivalents, you're not going to include in these things. If you used Garrison Noreen, and they were showing in the Garrison Noreen book, they were analyzing the cash account under the direct method, you'd have to go through and you'd have to look at all these things and you'd have to classify them. And not only would you have to classify, but you have to come up with meaningful captions for things, because you're going to do that cash flow and you need to have meaningful captions. And so if you use the direct method, then you would put it all together like this. It cuts off the ending cash here, but the ending cash, you could look at this and see the ending cash is going to be 63,000. And by the way, in your homework, it will be in millions, and you do not have to say millions anywhere in your responses. The indirect method, then, financing and investing sections will be the same as under the direct. The only thing that's going to be different is when you look at the income statement, and you will use that income statement in the operating sections. The operating section is different. So under the indirect method, I like this, which was provided by Garrison Noreen. 97.5% of companies use the indirect method. So using the indirect method, and I guess using straight line depreciation, are the norms, right? So under the indirect method, in the operating section, you start with net income. To that, you need to consider all the gains and losses. This is the gains and losses from anything that happens on your income statement. So in your income statement, you might have gains or losses from disposal of fixed assets. When you get rid of fixed asset, the cash that comes into your company is going to show up there as an investment in the investment area. And it's actually a reverse investment, right? Because it's going to be the selling of your PP&E, and that cash shows up down there. However, the income statement amount, be it a gain or be it a loss, it needs to show up in the upper part in the operating section. You will add a loss, subtract a gain. So what am I going to say about that? It's reversing signs again. The change in current assets and current liabilities, you go through each one of those accounts. Does it increase for a current asset? Then you decrease because you reverse the signs. For current liabilities, if you show an increase in current liabilities from one period to the other, it increased, then you show it as a positive number. So again, my rule is current assets, reverse sign, current liabilities, keep the sign. Then you have these other items, and the other items are the things such as depreciation, depletion, and amortization. You have all those other items. Well, on your assignment, I'm going to say, what are the items other than current asset and current liability changes that go in between net income and operating cash and or cash from operations? And you are going to have those two items on the bottom, and you're going to look at those two combined, and you're going to give me a total. So this top part is from current assets and current liabilities changes, and these items down here are really the non-cash income statement items. Okay, non-cash income statement item adjustments that are other than changes in current assets and current liabilities. Now, to combine this whole area here is the way we look at the difference between net income and operating cash. Okay, so this is operating cash income. This is accrual-based income. And these items here all combined are the adjustments that take us in between the two. So when I say if this number is close to this number, it's generally a good thing and we want them to be positive. What I'm saying is that the net that's in the middle is basically zero or very small. If you have a lot happening in between this number and this number, you're not going to be as confident in your net income and using the net income to gauge what's happening with the company. Okay, so if I say the difference between net income and cash flow from operations, and this is income statement items other than current assets and current liabilities, what's that change? You're going to add all this here combined together. So here is that again, memorizing this thing. Reverse the signs on current assets. Keep the sign on current liabilities. And as the other table told you, when you list your current assets, do not list cash and cash equivalents in there. So, current assets, reverse the sign. Current liabilities, keep the sign. Indirect method, a simple example here. They report net income of $125,000. Accounts receivable, reverse the sign. Accounts payable, keep the sign. Other adjustments which are necessary are non-cash income statement items such as depreciation, depletion, amortization, and gains and losses. So those are the things, all of these items that we're discussing up here will be included. Start with net income. Add depreciation, depletion, amortization amounts, anything that would be basically an expense that is a non-cash item is added. Anything that is revenue and it's a non-cash item is subtracted. So if you had an investment under the equity method, which you know is not cash coming into you, if it is revenue to you, then you would have to subtract it, right? And they don't include it here, but it's an item that's like that. And the amortizations, we have had a lot of those this semester. Another thing to consider is when you have deferred taxes, because when you have deferred tax accounts, those deferred tax accounts are items which are how do I say that? They are a part of that tax expense journal entry, but they are not showing up in current liabilities, right? So we'll talk about that later, but you need to think about that. And when you do your T account work, you need to list your deferred tax liability as a non-current account. So you'll understand this a little later. You'll probably come back and review this PowerPoint as you're working through that indirect method problem. All right, and then you have the changes in accounts receivable. When you actually work the problem, I need for you to list out, as we do when we work the carpet company problem, all the accounts receivable. Do they increase? Do they decrease? And again, reversing the signs based on increase or decrease. And then the accounts payable or all the other current liabilities, you'll need to list out each one of those. Okay, so you list out all of them. It happened that there were only two here that they had to list because that's all the example was. It was a short example. And then when you work through this, then that's all they have, and they come up with cash provided from operations of $140,000. Now personally, I'm looking at this and I'm saying 140 and 125, not too far apart. So I think that that's pretty good. Do not include cash as a current asset. Cash is already included. If you have cash equivalents, don't include the cash equivalents because they're also to be included when you do the statement. The statement is based on cash and cash equivalents. So if you want to work through this, I challenge you to work through this and see if you can understand the areas in which things go. Remember, when you have a cash dividend on 2, that's one of them that's difficult for students to understand. If instead of cash coming into us, it's cash going out, and because it involves that equity account, you are going to consider that a part of financing. When you do the indirect method and you get to an item like salary and wages payable, you would have classified that as a current liability. Under the indirect method, when you do current liabilities, those changes then show up in operating area. And then a repurchase of common stock. If you have stock transactions, they show up in financing. So any type of a stock transaction ends up in financing. And if you have repurchase, it's a treasury stock, and treasury stock is going to show up in financing.